The idea of this video is simple. I want to share 15 stocks that are perfect for a buy and hold portfolio. We're talking about well-run companies with ample growth prospects and share price upside in the years ahead. Be sure to stick around to the end because I think you're going to love that stock, a true hidden gem that deserves your attention. So, by the way, I'm Steve Reitmeister. I spent nearly 20 years as editor-in-chief of Saks.com, and now I'm a partner at WallStreetZen, where we analyze thousands of stocks daily to identify the market's strongest opportunities. But if you enjoy data-driven investing, then hit that like button. It tells YouTube to show you more research like this in the future. Let's get on with the show. We're kicking things off here. Our list of 15 buy and hold stocks with Escalade with a symbol of ESCA. And so no, we're not talking about the luxury Cadillac SUV. This is a nearly 100-year-old sporting and recreational goods company that has quietly outperformed the market for decades. Now, since I'm talking about 15 stocks in this list, I'm not going to go into great detail here. I'm mainly going to explain a few things I like about each stock and back it up with the data from our proven quant model, the Zen Ratings. In each case, they are A-rated stocks, putting them in the top 5% of all stocks based upon their stellar fundamental profile. This historically has pointed out stocks that have outperformed the market by nearly 3 to 1. Then I will drill down into the best of their 7 component grades to point out what is uniquely attractive about them, which increases the odds of future share price outperformance. But if you want much more information on these stocks, then check out the information on our free quote pages on WallStreetZen.com. Back to Escalade, right? Not the SUV. For one, it pays a dividend north of 3%. That dividend has grown consistently for over a decade. Likely that will continue growing into the future. They've also got very little debt on the books with a debt to equity ratio of just 0.29. That gives them more financial flexibility to fund future growth. Indeed, this is an A-rated overall stock. The 7 component grades are almost universally Bs across the board, which means they rank in the top 20% of all stocks in these vital categories. This includes a top 14% showing for value, which points to the share that should see more upside. Now, the sentiment score is the standout here, and this is A-rated because it's in the top 1% of all stocks tracked in our system. This means the smart money is already moving into these shares. Now, don't let the C for growth fool you. This stock may not be considered elite in that regard, but it's still in the top 24% of all companies analyzed in the growth category. Now, if top 24% is the stock's weakest rating, then it's quite easy to see just how strong it is across the board and why, after 100 years of excellence, it continues to be an attractive buy and hold stock. Now we move on to stock number 2. No doubt you've heard of this one. Now we're talking about Levi Strauss, the symbol LEVI. As the week I'm recording, this is the number 1 ranked stock in the A-rated apparel manufacturing industry. This has a lot to do with their transformation into more of a direct seller of their well-known products. This company should be in the dictionary next to the word consistency. They've beaten analyst estimates for 20 quarters in a row. Yeah, 5 straight years of earnings beats. Typically, the more that happens in the past, the more likely that continues to be the case in the future. These are not just A-rated shares reserved for the top 5% of stocks. In this case, Levi actually scored in the top 1% for its sparkling fundamentals. Now, as we look at the component grades, the highest ranks are for sentiment and financials, both landing in the top 7% of all stocks we track. The weakest score is the middle of the pack showing for momentum. Now, even with the earnings beat streak, investors are still asleep on this stock. But more importantly, the top 1% showing for the Zen Ratings says they may be set up for a long-term outperformer. Before I continue, if you like discovering high conviction stocks like these, then you can get even more by joining me every Monday at 7 p.m. Eastern Time. That is when I host my weekly live training session with timely market insights and top stock recommendations. Totally free, but you do need to register now. Just go to WallStreetZen.com/live. Rolling on to stock number 3 is Teradata Corporation, the symbol of TDC. Now, you probably haven't heard of this company, but maybe you should because they help big enterprises make sense of their information and ground their AI system in trusted data. Here's the hook. This is a cheap stock attached to a generally profitable growth business, and yet it only trades for 13.6 times forward earnings when the average stock is trading 50% higher than that. The market is pricing this like a company in decline when the numbers say quite otherwise, especially because they are riding a 12-quarter earnings beat streak, which generally points to more good times ahead. The component grades, right, those 7 different component grades reveal impressive strength with value in the top 7% of all stocks based on 21 different measures that point to undervalued shares. Even better is the top 2% showing for financials, proving they are a healthy and well well-run company. This company is enjoying robust growth thanks to soaring AI demand, and yet shares trade like a utility or consumer staple stock. This points to outperformance in the years ahead when investors finally take notice of this attractive growth stock. That's why it's on the list today. Next up, we have stock number 4 in Littelfuse with a symbol LFUS. This company makes the components that protect electronics from power surges. This is in huge demand for data centers, electric vehicles, and more. It's also the number 1 rated stock in the popular electronic component industry. Wall Street analysts are unanimously bullish on this stock. That's because every single covering analyst gives it a buy or strong buy recommendation. The Zen ratings also smiles upon Littelfuse with an A rating. In this case, we're talking about being in the top 2% of all stocks based upon its fundamental prowess. The 7 component grades are pretty strong across the board. We have a few standouts, including top 13% of all stocks for growth, top 11% for financial strength, top 8% for sentiment, which is what the smart money is doing, and top 6% for momentum, right? A body in motion stays in motion. No single flashy grade for Littelfuse, and that's the point. Broadly excellent fundamentals with no weak spot is worth a heck of a lot more over the long haul. Now we round out the first third of our 15 stocks with Astronics Corporation with a symbol of ATRO. This is one of the leading providers of power systems that go inside of both commercial and military aircraft. Defense budgets are climbing, not just at home but around the world, and air travel is running at record highs as well. That trend is unlikely to reverse anytime soon. Astronics sits right in the middle of both these growth trends. Wall Street analysts are wise to these positives. That's why they are predicting Astronics will grow at 6 times the pace of their industry. Maybe I should end the story there. But glad the good news continues, the top 1% showing overall for the Zen ratings. Now, their areas of strength, according to component grades, is the top 6% showing for momentum, and even better, it's the top 2% for growth. This is not just about the pace of growth, which is stellar, but the consistency of growth. The more consistently a stock is growing in the past, the more consistently it is likely to grow in the future. That type of growth engine generally rewards investors who get in early and keep riding to new heights. And by the way, if you want to see how I put the names like those to use in real time, then let that remind you to join me for my free live training every Monday. Yes, free. Register at wallstreetzen.com/live. But for now, let's keep rolling ahead. The power stays on as we move to stock number 6 in Generac with a symbol GNRC. This company is best known for its backup generators. With extreme weather and AI data center demand, the grid is under more strain than ever, and there's no sign of lessening demand in the foreseeable future. We're talking about a multi-decade demand. This is great news for Generac, who makes the backup and energy technology that fulfills that. Wall Street forecasts really stand out with well above average industry growth for both revenue and profits expected in the years ahead. And not surprisingly, these same analysts are overwhelmingly bullish on the stock with 10 strong buy and 2 buy recommendations from the street. On top of that, we have price targets that point to ample upside potential in the years ahead. Again, this is a better than average A-rated stock as they are in elite territory for their fundamentals. We're talking about being the top 1% of all stocks. The component grades that stand out here really are momentum, which ranks in the top 8% of all stocks, and growth, which is truly cream of the crop in the top 2%. Growing energy demand from AI, plus strong Wall Street support, plus stellar Zen ratings, especially that top 2% showing for growth. This all tells you why Generac could enjoy a multi-year surge in their share price and why it's worth considering for a long-term portfolio. Let's keep building our portfolio with stock number 7 in MYR Group with a symbol of MYRG. They build and maintain the electrical infrastructure that just about everything else depends on. Sounds boring, right? Wrong. How about the massive increase in power demand thanks to AI data centers and the changing of the U.S. electrical grid? Now do I have your attention? This is not just a theory. The growth is showing up in reality with 7 back-to-back earnings beats already in the books. Now, several component grades cluster right at the top. Momentum and safety are both in the top 5% of all stocks, while growth is in the top 4%, all owning to solid and continued demand. Now, perhaps even more impressive is the top 3% showing for financials, talking to a solid balance sheet and excellent operational metrics. A key risk for MYR Group is that it relies heavily on utility and infrastructure spending. Delays in any large grid modernization or renewable energy projects could slow growth and pressure earnings. But with aging power infrastructure, rising electricity demand thanks to AI, trillions expected to be invested in grid upgrades over the coming decades, the company clearly has a compelling long-term growth runway that should boost shares for years to come. Before the next stock, if you're enjoying these selections, and do yourself a favor and subscribe and turn on the notification bell. I put out this kind of stock research frequently. It's the best way to ensure you don't miss the next one. Now's where things start revving up. The names coming up are some of the strongest on the list today. That includes stock number 8 in MSA Safety with a symbol MSA. This company does something that truly stands the test of time. They make the equipment that keeps first responders and industrial workers alive. That's the kind of business that doesn't go out of style, which makes for a great long-term investment. On top of that, they have a fortress balance sheet that would make Warren Buffett blush, and surprisingly large gross margins near 50%. And just take a look at that earnings history. 16 quarters in a row of beating estimates. Pause and look at the EPS year-over-year change come. That's real consistency. And yes, the Zen Ratings component grades show well-rounded strength here as well. Value and sentiment rank the top 16% of all stocks tracked, but even better, safety is in the top 5% and financial strength is in the top 4% of all stocks. With MSA, there's no drama, no heroics, no story to babysit, just steady outperformance that befits the tortoise and hare fable, where we learn often that slow and steady wins the race. Now we flip from one of the most conservative picks to one of the most speculative. That brings us to stock number 9 in InfuSystem with a symbol of INFU. This under-the-radar company has a market cap of only $195 million. They provide the equipment used to deliver medication to patients directly to hospitals and clinics. In particular, they have a built-in durable niche, outsourced infusion therapy and medical equipment services. This gives them recurring revenue and a long runway as demand for outpatient home-based healthcare continues to rise. All this goodness is captured by the Zen Ratings, not just A-rated, but actually the number 1 ranked stock in the entire A-rated medical industry. This has a lot to do with its standout component grades. Now, financials are in the top 2% of all stocks tracked, and sentiment is the top 1%. The latter says the smart money has already discovered this hidden gem. All small caps carry extra risk, whether that be extra price volatility or larger competitors taking more market share from them. But right now, this company looks to be executing brilliant. That's why the smart money is already on board, and it's often a pretty good idea to follow their lead. We're rounding the corner on the next group of 5 stocks with number 10 in Science Applications International, the symbol SAIC. Now, this company provides technology and engineering services to the U.S. government. That's the whole appeal. Government contracts are sticky, and they don't dry up when the economy wobbles. You can see the stability in the numbers. This stock has a beta below 0.5. Historically, about half as volatile as the overall market. That stability is also because they have a massive backlog of business. We are talking about $23 billion currently on the books for a company that only does $7 billion in annual revenue. That gives great visibility and confidence into their future growth. All this fundamental goodness comes shining through the Zen Ratings, where they score in the top 2% of all stocks. The component grades that really jump off the screen is the top 5% showing for safety, and then for value, we have top 1%. The latter part is why I recently added SAIC to my Zen Investor newsletter portfolio. SAIC has the government relationships leading to $23 billion in contracts already in hand. This gives great confidence in years' worth of future earnings growth and share price appreciation, especially buying now while in the top 1% of all stocks based upon value. By the way, feel free to pause and get a drink of water or a snack if you need to, but don't click away because you'll want to hear about the next stock, which is Nucor with the symbol NUE. This is the largest and most efficient steel maker in America. As such, it sits at the center of the rebuilding U.S. manufacturing and massive infrastructure spending that's currently taking place. This stock has several attractive attributes worth naming. For starters, it's the number 1 ranked stock in the entire A-rated steel industry. Never a bad idea to go for the best stock in one of the best industries. Typically, it is hard for a larger company to score highly in the Zen Ratings. That makes Nucor truly stand out with their top 1% showing. Here again, this is a $50 billion large cap company. Looking at the component grades, we see financials in the top 11% of stocks tracked, sentiment in the top 10%, and momentum in the top 4%. Now, that top 4% for momentum tells you the market is actively rewarding the best-in-class name in steel right now. Yet, recently has endured a 20% sell-off from the highs, so it presents a healthy buy-the-dip opportunity. Now, if you're considering the stock, you should definitely know that Nucor operates in the cyclical steel industry. As such, weaker industrial demand or falling steel prices will pressure for earnings, but its industry-leading balance sheet, disciplined capital allocation, and consistent ability to gain market share have helped it outperform through multiple market cycles, and that party will likely continue for years to come. Now let's move on to lucky stock number 12 in Electromed with a symbol of ELMD. This is a medical device company that focuses on airway clearance devices. It's a simple and focused niche where they are the leader, flexing some real operational excellence. That operational excellence comes shining through when I share with you that they have enjoyed hearty 16% revenue growth in the past year, which has led to 46% earnings increase. That is several times the pace of their industry peers. On top of that, this company has next to no debt, which can be seen in the ultra-low debt-to-equity ratio of just 0.21. Plus, it has a low beta of just 0.47, half as volatile as the overall market. Nice qualities for a long-term buy and hold position. Now, right now, there are just over 200 stocks scoring a Zen rating A. Electromed is actually the 12th highest ranked. Rarefied air indeed. This excellence shows particularly with its financials and sentiment grades, which land in the top 1% of all stocks tracked. When the balance sheet grades this high and the smart money is already moving in according to the sentiment grade, this is a great setup for a multi-year compounder in most anyone's portfolio. Now on to stock number 13 in RingCentral with the symbol RNG, a company that runs cloud-based communication systems. It's actually the phone system we use at WallStreetZen. Here we have a fast-growing software company trading at a value stock price. Let me back that statement up with some impressive numbers. According to Wall Street estimates, RingCentral is expected to grow earnings per share by 46% a year over the next 3 years. Amazingly, it trades for a PEG ratio under 0.5. Anything under 1 suggests you're getting a great value for the expected growth, meaning this stock is a downright steal. Once again, we have an elite A-rated stock, this time in the top 1% of all stocks based upon that stellar fundamental profile. The holy trifecta of component grade starts with growth, ranking the top 4% of all stocks. Then we have both 1% showings for value and financial. That trio is truly elite. Cheap, growing, and financially sound all at once. That is rare and makes for a compelling investment setup. As for the risk, I should mention that competition from tech giants like Microsoft and Zoom could make it harder for RingCentral to grow, but its sticky subscription business, enterprise relationships, and AI-driven product expansion still support a compelling long-term outlook. This is what leads to Wall Street's ample growth prospects and its stellar Zen rating. For now, the reward seems to much outweigh the risk. If you made it this far, then I'm guessing you're getting some value out of this video. Thus, I want to give you even more value by personally inviting you to my next weekly live training session. I like to kick things off with a timely market update plus investment plan to outperform. Then I finish up strong with my trade of the week, combining the best of the Zen rating system with my greater than 40 years of investing experience. Now, it's free, but you do need to register. Just go to wallstreetzen.com/live or click the link in the description or scan the QR code on the screen. I look forward to seeing you this Monday. We only have 2 stocks left to go, which brings us to number 14 in Bioventus with a symbol BVS. Here's the most impressive thing about this stock. This is the single highest rated name we track. Yes, out of the more than 4,600 stocks in the Zen Ratings database, this is ranked number 1. That says that it truly has a special fundamental profile, which is why I added to my Zen Investor newsletter portfolio. This medical device company is truly riding a multi-year trend that should lead to rising growth and a rising share price. That trend is the aging of the worldwide population, the perfect demographic for their focus on joint and bone therapies, where demand most certainly increases with age. Now, right now, Wall Street expects 18% year-over-year earnings growth towards 2030, and yet the stock trades for only a lowly PEG ratio of just 0.61. This is great value for the outside growth on the horizon. On top of that, Bioventus has a strong earnings track record with 12 consecutive beats on the books. Perhaps even better than the beats is that year-over-year earnings increase that you will see in the earnings column on the far right. Wall Street analysts are overwhelmingly positive, with a consensus strong buy recommendation, plus an average fair value price target implying almost 60% upside potential in the year ahead. As I already shared, this is the number 1 ranked stock overall for the Zen ratings, thus not a surprise they score in the top 2% of all stocks for value, followed by top 1% for both growth and sentiment. True, Bioventus faces the risk that reimbursement changes or slower adoption of its its orthopedic products could limit growth. This is true for all medical device companies. But its expanding portfolio of most musculoskeletal therapies, improving execution, and strong demand trends give it meaningful long-term upside. Not to mention the top-notch Wall Street support and #1 standing within the Zen rating. Now, let's close it out with a stock that really embodies the true meaning of the buy and hold mentality, and that is Gentherm with a symbol of THRM. This company provides systems that heat, cool, and regulate temperature. Now, before you fall asleep, let me clarify something. Its biggest business is in cars, and increasingly that means the systems that keep EV battery packs running smoothly. This demand is only growing, right? The thesis is simple: tremendous value relative to attractive growth prospects. This shows up in their PEG ratio of only 0.58. Now, really, these days, anything under 1.5 is considered quite reasonable these days. Anything under 1 is obscenely undervalued, right? But that only matters if the growth is real. And right now, Wall Street seems pretty enamored with Gentherm, with expected 19% annual growth coming in the next 3 to 5 years, right? 19% per year. Indeed, we are finishing strong on the Zen ratings front as well, with another top-tier A-rated stock. This one in the top 1% after the full 115-factor fundamental review. Digging deeper into the component grades, we see that growth is in the top 8% of all stocks tracked, but even better is the top 4% showing for safety and sentiment. Now, what's not to like about that? Sure, any auto production slowdown would pressure Gentherm's growth, but its leadership in vehicle thermal management and growing content per vehicle supports a strong long-term outlook, not to mention the dirt cheap valuation. Okay, you made it. Which of these 15 stocks caught your eye? Don't be shy. Put it all down in the comments section below for the benefit of our community. Now, if you're not sure what to watch next, check out the video that's popping up on your screen right now. It features 3 stocks I unearthed using Warren Buffett's playbook that will be of great interest to investors with a buy and hold mentality.